Hey everyone, welcome back to Corporate Decoder, the place where we break down complex financial news. And today we are diving deep into Soulpower Acquisition Corporation's latest quarterly report. And let me tell you, this one has some serious eye-openers, especially concerning when they plan to go public. So, what is the big story here? Soulpower Acquisition Corporation, a company focused on finding a business to merge with, has just laid out its financial picture for us. It is a SPAC, a special purpose acquisition company, and these guys exist pretty much just to buy another company. Think of them as a blank check company ready to make a deal. And their latest filing gives us a snapshot of where they stand financially right before their big move. This is the official document, the Form 10Q, for the quarter ending the 30th of September 2025. It is like a company's report card for that specific period, and we're going to see how Soulpower performed and what their plans really look like. First off, let's talk about the shares. As of the 12th of November 2025, they had over 25 million Class A shares and more than 8 million Class B shares. Those Class B shares are often called founder shares, and they usually come with special voting rights or other perks for the initial investors. Now, let's get into the money, the balance sheet. This shows us what the company owns, what it owes, and what its owners have invested. This is a massive number, over $255 million held in a trust account. This is the money they raised from their initial public offering, or IPO, and it is essentially set aside waiting to be used for a business combination. This is the core of a SPAC's operations, and their total assets are just over $255 million. Most of that, as you can see, is that cash sitting in the trust account ready for action. Here is something interesting. They have nearly $9 million in deferred underwriting fees. This is essentially money they owe to the investment banks that help them go public, but it is only paid out if they actually complete a business combination. It is a way to align the underwriter's interests with the company's success. And here is the critical part for SPACs. They have Class A shares that are subject to redemption. This means that if the company doesn't find a business to merge with within a certain time frame, the shareholders who bought shares in the IPO can get their money back. The redemption value is set at over $10 per share, backed by all that money in the trust account. This redemption feature is huge because it protects the investors who put their money in. Now, looking at the shareholders' deficit, it is a negative number over $8 million. This just means that their liabilities and the redemption value of shares exceed the value of other equity for a SPAC. This is pretty normal, especially before they find a business to acquire. Remember, they have a ticking clock to use that money in the trust. Let's move on to the income statement. This shows us how much money the company made and spent. For the 3 months ending the 30th of September 2025, they earned over $2.6 million in interest from the cash held in their trust account. And then for the 9 months of the year, that interest income jumped to over $5.1 million. This is where their current income is coming from. They're not running a business yet, so they're just earning interest on the money they raised. As a result, for the 3 months, they reported a net income of over $2.2 million. And for the 9 months, it's a hefty $4.2 million in net income. Again, this is mostly from the interest on their trust account funds, not from any actual business operations. And here is a key number. For the Class A shares, the weighted average shares outstanding for the 3 months was 25 million. This translates to about 7 cents in earnings per class, a share for the quarter. For the Class B shares, the weighted average was over 8.3 million, and for the Class B shares, this resulted in a net income per share of 7 cents as well for the quarter. But wait, looking at the 3 months ended the 30th of September 2024, the Class B shares had a loss of 2 cents per share. This might seem a bit confusing, but typically Class B shares, especially founder shares, can have different calculations for earnings per share due to their unique structure and potential forfeitures. Let's jump over to the statement of changes in shareholders' equity. This table shows how the different components of equity have changed over time. If we look at the 31st of March 2025, right before their IPO, they had about 7.6 million Class B shares outstanding. Then something happened here on the 30th of June 2025. They saw a big jump in Class A shares, all thanks to the sale of 620,000 private placement units. And look at this. There is an allocation of $4.5 million for the fair value of public rights. These rights often come attached to the IPO shares, giving holders the option to buy more shares later. This number represents a significant adjustment related to those redeemable shares. Basically, the value of those shares is increasing over time towards that redemption price, $10.21 per share, and this adjustment eats into the company's equity. By the 30th of September 2025, they had 620,000 Class A shares issued and outstanding, along with over 8.3 million Class B shares. Their total shareholders deficit Remember that negative equity was around $7.8 million. Now the cash flow statement, this shows us where the cash came from and where it went. The most significant transaction here is the $250 million deposited into the trust account. This is precisely the money raised from the IPO and private placements earmarked for a future acquisition. They received $245.6 million from their IPO and another $6.2 million from private placements. This adds up to the $250 million that went into the trust account. Overall, their cash position increased by about $359,000 by the end of the period. And a really important non-cash item, a deferred underwriting fee payable of $8.8 million. This again is that fee they owe to the underwriters contingent on a successful business combination. Okay, so what is this company, Soulpower Acquisition Corporation? Essentially, it is a blank check company formed in May 2024, just like we said, to find and merge with another business. They haven't started any actual operations yet, and they won't until they complete their business combination. Their big IPO happened on the 3rd of April, 2025, where they sold 25 million units, each unit containing a share and a right to get a tenth of a share later, and they raised a cool $250 million. On the same day, they also sold more units in a private placement, bringing in another $6.2 million. Here is the crucial part for SPACs. They have a limited time, a completion window to find a business to merge with. If they don't, they have to wind down and return the money to shareholders. They've classified these redeemable class of shares as temporary equity, which means they're not considered permanent ownership until a business combination happens. It is a bit technical, but it shows these shares are treated differently because of the redemption possibility. This section talks about how they apply accounting rules. They're an emerging growth company, which means they get some flexibility with reporting rules. They've also elected not to use an extended transition period for new accounting standards, meaning they'll adopt them like other public companies. They also explain how they determine fair value, which is essentially what a willing buyer would pay or a willing seller would accept. Interestingly, they are incorporated in the Cayman Islands and are not currently subject to income taxes in either the Cayman Islands or the United States. This is common for shell companies like SPACs, before they have active operations or significant income. They've classified the rights issued with their shares as equity. These rights give holders the option to acquire more shares later, and how they're accounted for can impact the company's financials. So looking at the valuation of these rights, they used a few key assumptions. The traded price of the unit was $10, and they estimated an implied share price of $9.82. They also factored in an expected term to day SPAC, which is basically when they complete their business combination, and a probability of that happening. Free rate and dividend yield are also part of this calculation. This section just details the IPO itself. They sold 25 million units at $10 each, raising that $250 million. Remember, each unit had a share and a right. This just expands on the private placement where they sold those additional 620,000 units to the sponsor and an underwriter, raising that additional $6.2 million. Related parties are people or companies that have a stake in them, like their sponsor. The founder shares were issued to the sponsor for a nominal amount, just $25,000 for over 5.7 million shares initially. Then there were some share capitalizations and adjustments leading to over 8.3 million Class B shares. These founder shares often represent a significant chunk of equity for the early backers. There is an administrative support agreement where they pay their sponsor's affiliate $5,000 a month for office space and support. It is a small cost but shows the ongoing relationship. They also mention potential working capital loans from the sponsor or officers. These are loans to cover operating expenses if needed, but they are not guaranteed. And importantly, these would be repaid before any money from the trust account is used. They had a promissory note with the sponsor for up to $135,000, which was later increased to $300,000. But as of the 30th of September 2025, there was nothing outstanding on that loan. This section covers potential future obligations or risks. They mention general market risks due to geopolitical events like the conflicts in Ukraine and the Middle East. It is a standard disclosure, but it highlights that external factors can impact their ability to find and close a deal. And here is the deal with the underwriters. They got a cash fee of $4.4 million. And remember that deferred fee of $8.8 million that only gets paid if they complete the business combination. This note goes into more detail about the different classes of shares. They're authorized to issue 20 million Class B shares, and as we saw, they have over 8.3 million outstanding. These shares typically convert into Class A shares when the company goes through a business combination. The rights are here too. Holders of these rights will get 1/10 of a Class A ordinary share when they complete a business combination. No fractional shares, so they'll either round up or down. This explains how they determine the value of certain financial instruments, like those rights, using market data and assumptions. For a company like this, there is only one business segment, the SPAC itself. They're not broken down into different product lines or geographic areas. Their chief operating decision maker, or CODDAM, which is their CEO, looks at the interest earned on the trust account and the overall company performance to make decisions. This is where management talks about their own financial situation. They reiterate that they are a blank check company formed to do a business combination. They acknowledge that finding a business and completing the combination will cost money. They also mention new CC rules for SPACs that became effective in July 2024. These new rules can make it harder and more expensive to complete their business combination, which is a pretty big deal. They confirmed that their net income for the quarter was over $2.2 million, mainly from interest earned on the trust account, with operational costs of about $400,000 trimming that down. Before the IPO, their money came from the sponsors' investments and loans. Then, the IPO brought in $250 million. And again, as of the 30th of September 2025, they had over $255 million in that trust account. They also note that if finding a business costs more than they expect, they might not have enough money to keep operating before the merger. And while the sponsor can lend money, it is not guaranteed. Good news here, besides that small monthly office fee, they don't have any significant long-term debt or liabilities. That $8.8 million deferred underwriting fee is the big one, but it is contingent. And as we saw before, no income taxes for them right now. As a smaller reporting company, they don't need to provide detailed market risk disclosures. They've stated that their disclosure controls and procedures were effective as of the end of the quarter. This means they have systems in place to make sure important information gets reported on time. They're essentially saying that the risks they outlined when they first went public are still the main risks they face. They mainly point back to their original IPO prospectus. This is a recap of the IPO and private placement, emphasizing how the money was raised and what it was used for. Most importantly, to get that $250 million into the trust account. And finally, here is a breakdown of those offering costs we saw earlier, over $13 million in total. Now let's look at the big picture. What does all this mean for Soulpower Acquisition Corporation? On the positive side, they have that substantial $255 million in their trust account, providing a solid war chest. They also have minimal debt, which is always a good sign. Their income is currently driven by interest, which is stable but not indicative of future business success. However, the biggest challenge for any SPAC and for Soulpower is the ticking clock. They need to find and complete a business combination. The recent SEC rules could make this harder, potentially increasing their costs and extending the timeline. The fact that they have no operational revenue and are entirely dependent on finding a target business means the success of this company hinges on smart deal. Making their past performance, which is essentially just earning interest on parked money, tells us very little about their future business acumen. In terms of strategy, they are in a classic SPAC situation. They need to deploy that capital wisely by acquiring a company that can generate real profits. The key risks are failing to find a suitable target, the market conditions changing unfavorably, or the integration of an acquired company not going as planned. Overall, Soulpower Acquisition Corporation is in a holding pattern, much like many SPACs. They have the funds, but the real test will be their ability to execute a successful business combination in a potentially more challenging regulatory environment. Their future success is entirely dependent on the quality of the deal they can strike. Alright, that is our breakdown of Soulpower Acquisition Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they will find a great business to merge with? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord linked in the description for more discussions and insights. Thanks for watching. See you next time.